There are more than 16,000 sanctions imposed against Russia, 11,000 of them aimed at individuals, 4,600 at entities including financial institutions, and the remaining directed at ships and aircraft. European airspace is close to Russian planes, and hundreds of Western companies have pulled out of Russia completely. Western sanctions against Russia should have crippled the economy. It should have stopped Russia's military. It should have crashed Russia's currency, but remarkably, none of this has happened. If you go to Russian grocery stores, the aisles are full, prices are low, and people are living a normal life. Despite famous Western brands pulling out of Russia completely, their latest products are still on the shelves of new stores, like this one, selling the latest iPhones and MacBooks. So how did Russia do it? How could any country in today's day of age survive a record 16,000 sanctions? What's even more challenging for Western countries to figure out is how did the Russian economy grow by 3.6% last year, better than any G7 country, and is now forecasted to grow an additional 2.6% this year. Of course, it's no secret by now that Russia has shifted to a wartime economy. For the first time in modern history, Russia is set to spend 6% of its gross domestic product on the military, as defense spending will exceed social spending in 2024. The war in Ukraine is not only the Kremlin's biggest priority, it is now also the main driver of Russia's economic growth. At a time when Ukraine's President Zelensky is scrambling to acquire arms, funds, and recruits, Putin seems confident that he can win the war on his conditions. Meanwhile, some of the most prominent American geopolitical voices are starting to say the hard part out loud. Stephen Walt, a professor of international relations at Harvard University, recently advocated in this article for Foreign Policy that NATO should not accept Ukraine for Ukraine's sake. I also recently sat down with Colonel Douglas Macgregor, the former advisor to the U.S. Secretary of Defense, who shared this insight about Zelensky.
The Zelensky regime in Kiev, because I reject the notion that Zelensky is the popularly elected leader of Ukraine. I have serious doubts about that. I don't think he enjoys much legitimacy inside his own country anymore. He's widely hated, but he's also widely feared because of the Ukrainian secret police that threatens anybody that challenges Zelensky. He is now a fatally wounded animal. He's dying. His regime is dying. Ukraine is defeated. And as a result, he's striking out in any way that he can as a last gasp effort to, one, persuade people that there is some life left in his regime, two, that he could miraculously recover and win, and three, as a matter of personal vengeance for what he thinks is being done to him.
While the future of Zelensky and Ukraine remain uncertain, we know Russia will be led by Putin for the foreseeable future. So how have 16,000 economic sanctions from some of the most powerful countries on earth failed to derail him? The answer might surprise you. But if you've been watching the precious metal market over the past few months, you'll have seen the price of gold continues to shatter all-time highs. The answer is Putin started using an incredible gold strategy he stole from the United States in order to bypass economic sanctions, which ironically was led by the US. It's actually a very interesting case study on global economics, but one you can also implement in your own investing portfolio, but more on that later. In order for Western-led sanctions to be successful, they needed to be strategic, targeting the environment it works in. The economic sanctions from the West targeted shipping and trade into Russia, but the gold market is a massive market that was completely left untouched from Western sanctions. According to the World Gold Council, Russia is now the second largest producer of gold at 324.7 metric tons in 2023, which only trails China at 374 metric tons. What's more, Russia is forecasted to increase gold production by 4% a year until 2026. Here's something you probably haven't heard in Western media before, but something the Carnegie Endowment for Peace published just a few weeks ago in this article entitled, "Why Russia Has Been So Resilient to Western Export Controls." Incredibly, Russia has been preparing for economic sanctions since 2013 and managed to isolate its economy from transactions requiring US dollars. Once again, when you break down the facts of what's happened with these economic sanctions, it's incredible how ineffective they've been in stopping Russia's growing economy. Let's take semiconductor chips, for example. Russia's domestic chip market is both outdated and undersized. In theory, Western sanctions should have crippled Russia's tech industry. Russian factories operate at 65 nanometer chip technology, which is about 15 years behind the US. The US thought that they had Russia trapped in a corner. There was no chance for Russia to develop these chips domestically. By cutting off Russia's access to the newest chips, that should have been it. Russia's tech industry should have been over. Its military couldn't possibly build more armory and advanced weapons. The West will win and Russia will be defeated. But none of that came to fruition, and within 1 year, Russia's tech supplies have rebounded to pre-war levels. So how did Russia pull this off? They did so by using a three-point strategy. First, Russia started importing run-of-the-mill computer chips and components found in consumer products that often come from US manufacturers but are rarely subject to export controls. Second, Russia used a third-party network of traders who have access to components for tanks, missiles, and drones. And third, Russia took advantage of changing geopolitics. The shift we've seen around the globe, moving from a unipolar world controlled by the US to a multipolar world with multiple superpowers, gave Russia incredible leverage. Countries like China, India, Turkey, and the United Arab Emirates all chose to ignore Western sanctions and not only sustain trading ties, but expand them. No surprise here, but the country benefiting the most from this expansion and trade was China. In 2020, the total trade value between Russia and China was valued at $107 billion. But fast forward to 2023, and the total trade value between these two strategic partners is now valued at $240 billion, a 124% increase in just 3 years. Half of Russia's oil and petroleum was exported to China in 2023, and according to Chinese customs data, Russia is now China's top oil supplier. But if you think imports to Russia are only coming from countries like China and North Korea, think again. I'm filming today's video in London, and whilst reading the Times this morning, a news story broke out on the details of how British luxury cars are still being sold in Russia despite sanctions. Whilst the UK government stood in alliance with the US by imposing economic sanctions, once again, profits and the chance to cash in among Russia's elite wealth was just too much of an opportunity to pass. Rolls-Royce and Bentley shifted their focus to neighboring countries and started importing their luxury vehicles to Belarus, Armenia, Azerbaijan, and Kazakhstan. Now look at the trade numbers and it will shock you. The number of Jaguar Land Rovers shipped to Kazakhstan has increased by 5,190% since before the Russian invasion. Meanwhile, UK car exports to Azerbaijan have increased 795% versus pre-invasion. There was certainly a time in history where economic sanctions carried much more weight and consequences, but in today's global economy, it seems sanctions are effectively useless. But now let's break down the economic strategy Putin stole from the United States and how he used it to stabilize his currency and economy. In 2022, Putin decided to peg Russia's currency, the ruble, to gold. 5,000 rubles was the standard and could be used to purchase 1 ounce of gold. Of course, the United States was the last major economy to use the gold standard. The US dollar used to be one of the most stable and valuable currencies in the world, but the purchasing power of the dollar is decreasing every year and has only accelerated even more in recent years with rising US inflation. Usually the rationale for holding on to gold reserves is to use them to settle foreign transactions at both home and abroad. Gold can be swapped for currencies to settle transactions and then swapped back into bullion. Because the world is filled with so much uncertainty and instability, central banks around the globe are stockpiling the asset. Over 1,073 metric tons of gold were purchased in 2022 alone. 2023 was just slightly lower, meaning that in the past 2 years alone, central banks around the globe have spent over $220 billion acquiring gold. Now, due to Western sanctions against Russia, the UK, United States, and Canada will not touch Russian gold. But don't forget, 85% of the globe is not sanctioning Russia. One of the biggest customers that have emerged is the United Arab Emirates, who imported 96.4 metric tons of gold. That's worth over $6 billion alone in 2022. That figure represents a 15x increase from pre-war imports. Another big client of Russia is the independent country of Switzerland. In 2022, Switzerland imported 75 metric tons of Russian gold, worth $4.87 billion. And in 2023, Switzerland followed the business model of Britain's luxury auto exports, importing an incredible $8.22 billion of gold from the UAE and another $3.92 billion from Uzbekistan. Of course, all the gold from both the UAE and Uzbekistan come directly from Russia, so once again, a creative workaround from US economic sanctions. The result is Russian gold worth hundreds of billions of dollars is now being freely traded at top dollar while avoiding every one of the 16,000 sanctions. Now, for Putin's plan for economic resilience through gold to work, gold needs to increase in value over the long term. The last few months have been great news for gold investors. Just last week, a CNBC article showed how gold hit record highs propelled by US interest rate cut expectations and strong safe haven demand. But honestly, Russia pegging its currency to gold and using it for stability in fearful times is an investing strategy that you can steal as well. In my opinion, precious metals should absolutely be part of a balanced investing portfolio. I've been an active gold investor for years and have partnered with Lear Capital to be my precious metals expert and sponsor of my video today, because Lear has been helping investors like me purchase gold and silver for almost 30 years. They have over 3 billion in trusted transactions, thousands of 5-star reviews, and are the only gold company with a 24-hour risk-free purchase guarantee. But everyone, this is not a hard pitch from me. I'm not trying to sell you anything in today's video. Many of you know that I'm an active investor and I simply share opportunities I see in today's ever-changing world. The best thing about Lear is the quality education you can receive about investing in precious metals. Simply call Lear Capital for your free gold and silver investor kit. They'll send you a must-read report that explains how the price of gold rises right along with our rising US debt and makes a great case for gold reaching $3,200 an ounce. With US debt hitting $34 trillion in printing, precious metals can be the difference maker for your savings in retirement. Call today and mention my name, Cyrus, and Lear Capital is going to gift you $250 in credit simply for just contacting them. Simply call 800-489-6450. That's 800-489-6450. or go to learcyrus.com. Now, while gold remains an incredible asset to own, it's not the only strategy that Russia has for its future. Last month, Russia announced a new BRICS currency that will incorporate digital assets and cryptocurrencies on the blockchain. Russia is a founding member of the BRICS alliance, along with China and India, and here are the words of Russian diplomat Yuri Ushakov, who states, "We believe that creating an independent BRICS payment system is an important goal for the future, which would be based on state-of-the-art tools such as digital technologies and blockchain. The main thing is to make sure it is convenient for governments, common people, and businesses, as well as cost-effective and free of politics." Boasting the largest economy in Latin America, Brazil's President Lula da Silva has been a vocal supporter of developing countries finding a way to avoid the US dollar in foreign trade. Last year, when visiting Shanghai, he stated, "Every night, I ask myself why all countries have to base their trade on the dollar. Why can't we do trade based on our own currencies?" Who was it that decided the dollar was the currency after the disappearance of the gold standard? Everywhere you look, there are incredible things happening in geopolitics. Russia is pegging its currency to gold, bringing back the gold standard. We have a new cryptocurrency that is potentially being launched by BRICS. All of this is going to change everything we know about the world of global finance. And BRICS founding member China is making the most aggressive moves, stockpiling gold for the past 16 months while simultaneously reducing its US dollar reserves. But again, it's not just China. Like I mentioned earlier in the video, the World Gold Council reported that central banks bought over 1,000 tons of gold in 2023. This even prompted Thomas Hill, a former State Department employee, to speak out on why the world moving away from the US dollar should alarm our lawmakers. The BRICS-led de-dollarization effort should alarm US policymakers. It is clear that traditional US allies such as Egypt, Saudi Arabia, and the UAE are all exploring ways to de-dollarize, and that Beijing is helping that process move forward. Everyone, as I've preached for a long time on this channel, the multipolar world is here, and there has never been more uncertainty for the future of our world. The Russia-Ukraine conflict continues to provide insecurity and instability in Europe. Israel's war in Gaza threatens to escalate into a larger regional war throughout the Middle East, potentially even bringing in Turkey, which is the gateway to Europe. And even tensions in the Taiwan Strait and South China Sea could see the two largest superpowers in the world, in the United States and China, escalate into a conflict that would do nothing but harm for the future of humanity. With a potential new US president coming in 2024, who knows what the future will bring? But as always, you can count on this channel for bringing you the best insights into global geopolitics. And once again, a huge thank you to Lear Capital for sponsoring today's video. And trust me, even if you know nothing about investing in precious metals, it's worth your time to give Lear Capital a call. They are happy to chat with you, send you more information, and once again, this is not a hard pitch or sell. They're just going to give you more information so that you can be more knowledgeable about how gold is playing an important role in geopolitics and the future of our world today. Simply call 800-489-6450 or go to learcyrus.com. Everyone, thank you as always for your incredible support. Drop me a comment down below and let me know what you think, and I look forward to seeing you all in our next video soon.